Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. Happy Monday. We are going to have a look here at a bit of housing data today. We've talked about, of course, the issues that are being had in commercial real estate in the wake of the issues with SVB and the smaller regional banks being a sort of ground zero for originating commercial real estate mortgages and the problems that we might be experiencing there. But today, I thought we might look at the housing market itself. And that, of course, ahead of some economic data that we're going to get this week. Last week, we had building permits and housing starts. This week, we have new home sales and pending homes sales. And so I thought, why not have a look at the housing market and see what that is looking like? So here we are. You can surely see where the thrust of this conversation is going to be going here. So let's take a look and see why it is that the U.S. housing market probably faces deeper losses. So the first thing I want to take a look at here is the sequencing. So let's walk through and see how this works, because the housing market is certainly a bit of a special character. So you can see here that we're starting with a situation here where it's already the first quarter of 2020 where interest rates bottom. Now, obviously, this is well before any Fed rate hikes. Well ahead of them. This is the start of COVID. And so you can see there that rates bottom as you get that risk aversion really hitting and the initial level of that risk aversion start to ease. So in that first quarter, you have the Fed introducing open-ended QE, near-term rates, of course, collapse. But longer-term rates start to creep higher as those actions begin to have a positive effect. And so you can see already in the first quarter of 2020 is when you get the bottom on long rates, and from there they start to creep upward. You can see that initially what this does for pending home sales, and I'm looking at pending as a baseline. If you were to look at new home sales, existing home sales, they would look very similar here. That line would look essentially the same in terms of the trend. The magnitudes, of course, would be a bit different, but the trend looks very much the same in terms of its key inflection point. So I thought I'd go with pending as a catch-all. So you can see here that by the third quarter of that year is where pending home sales start to roll over. You of course, initially have that surge around the start of COVID because everybody is going home. There's lockdowns. Everybody's working from home. And so there's that COVID-induced surge in housing sales because everybody immediately rushes to make adjustments for a world whereby they don't go to work and they have to set up themselves to function basically in a locked down environment. You can see that the move in 30-year rates starts to show up in mortgages only in the fourth quarter of that year. And so that surge in home sales is happening before mortgage rates really start to move higher, which of course helps that to occur. And then as mortgage rates start to rise, so too you see home sales start to wobble. Then by the third quarter of the following year, Fed policy expectations start to shift. Now, of course, we know that by the middle of 21, the Fed essentially admitted that inflation didn't look as transitory as they thought initially, and said, okay, we're going to have a tightening cycle here. So you can see that the bottom in rates is the back half of that year. And then, of course, as we get into the first quarter of 2022, that's where Fed rate hikes actually come into the picture. You can see that's where Fed policy expectations really start to steepen. The red line there, by the way, not just immediate Fed rates, but the 12-month view forward. So this is where do Fed funds futures expect the Fed's target rate to be 1 year forward from any given time. And so, and these are, of course, quarterly charts, as you can tell by the labeling. So what you have here then is a situation where by the beginning of 2022, Fed rates actually start rising, and the expectation for where they're going to be in a year, of course, naturally moves higher as they go up. And so you see them building then going into this year. But all of essentially all of last year, you see rates move higher. You see then pending home sales accelerate downward, and mortgage rates, of course, surge in the vicinity of 7. So, not surprisingly, as it becomes more expensive to finance a purchase, sales really accelerate in their decline. Now things start to get interesting. As the Fed really ramps this up, you also get a turn in housing supply. So as the market initially starts to decline back in the third quarter of 2020, you don't really have that kind of a response from supply, because at this stage, we're still talking about maybe this is temporary. Maybe the Fed is not going to go on a big hike cycle. And so to meet that surge in sales, which you can see occurs in the front part of 2020, you thereafter have a surge in building permits and housing starts. First, the permits, of course, have to be obtained, then starts can be had once those permits are in hand. And so you can see that's the front part of the housing supplies story. That starts to chase the sales, of course, to be able to clear that market. And you can see that really doesn't start falling off until Fed rate hikes begin rising. So once the market concludes, okay, we're going to have much higher mortgage costs, we'll see how much higher, we'll see for how much longer at that stage, but it's going to be higher. The Fed is going to make financing a home more expensive. That's where supply starts to really get cut. And both housing starts and building permits start falling. All of this doesn't end up in the price of housing until the second quarter of 2022. So this, of course, is where things get really interesting. Housing is notoriously slow in terms of the price response to market conditions. And this is because, of course, it takes a really long time to buy and sell a home. It's not as straightforward as buying or selling a stock, which you can, of course, do at a click. It's not as easy as trading any real kind of on exchange or even off exchange asset. Where what you're doing is you're buying or selling something that can be done electronically, something that isn't physical per se. But needless to say, the buying and selling of a home takes a long time, months at best. And so what you have here is an almost 2-year lag between where sales peak and where the price of homes actually starts to dip in response to all of this. Now, what this makes for is a very interesting scenario indeed as we look forward. So what you see here is those same building permits and housing starts that we saw earlier. You can see them start to head lower as we get the Fed rate hike cycle going. You can see both mortgage rates and the Fed funds 1-year outlook here moving higher in tandem. But what you also see is that at the end of last year, you seem to have a peak in Fed rate hike odds. Now, of course, since then, we've had a banking crisis. We've had those rate hike odds initially surge in February, then crash in March. Now they're kind of evening out in April to where we're just about back to where we were. And we'll take a look at them in just a second, but just about where they were going into this year. So we've kind of gone up, gone down, and we're settling back around where we were as calendar year 2023 got underway. But what you're seeing is you had pretty much a one-way move higher in quarterly terms on Fed rates. And now, at least in the first quarter of this year, there's been a dip, the first real dip in this in this path. What you also see is that housing supply is seemingly responding. So home builders are perhaps looking at the peak in rates and saying, well, mortgage rates maybe are done rising. So what we perhaps should be doing is feeding more supply into this, because demand is going to be perhaps returning if rates are easing. It's possible that consumers will say, well, we weren't looking to buy into a rising rate environment because mortgages were getting progressively more expensive. Now that they've stopped being more expensive, looking forward, perhaps, of course, nobody knows exactly, the Fed might accelerate the rate hike campaign, and we'll talk about that in just a second. But for the moment, it looks like perhaps rates have peaked, and so perhaps there is the incentive here to begin to create more supply in anticipation that prices will be such that there will be an attraction of buyers. As we just saw, they've started to dip. And so building homes is obviously a longer term endeavor. Maybe this is the time to start to create more supply. It'll take a few years to really get that supply to be operational. Now, does that make sense? Well, looking at where we are on the Fed policy curve, the idea that rates have peaked is certainly being borne out, at least in market expectations as they currently stand. So you can see the little dotted line there that's bulging above the others. That's where the curve was before the SVB collapse. So that's that run of good data that the U.S. saw in early February. That gave us a terminal rate at the time that was closer to 5.5%. You can see we've since significantly come in. And what we're looking at now is more like a terminal rate in the 5 to 5.25 range. Recall the Fed sets policy in ranges, in a 25 basis point range. It looks like we're going to get to the peak in that range within a month. You can see there the rise from the current policy rate of 4.88 up to 5.1. That would be right in the middle of that 5 to 5.25 range. That's one more hike. We stay in that range and don't go north of 5.25. So that ostensibly is the peak. And then within 6 months, we're in rate cut mode. So looking out to perhaps October, November, there is no policy meeting in October for the Fed. So we're looking at perhaps November here for the 6-month mark. You can see we're already sub 5. And then within a year, we've shaved 100 basis points off the Fed funds rate. Now we're at 4. So over the course of essentially a year, we've gone from a peak at 5 in May, so next month, which is of course at this point just mere days away. The next Fed policy announcement is May 3rd, which is mid next week. We go basically from there to 4 within a year and 3 within 2 years. So 100 basis points in cuts between this May and next, and another 100 basis points in cuts between that May and the one after. So what we then see is indeed a story where rates, in line with what we're seeing here, have probably peaked and continue lower from here, at least as far as market expectations are concerned. And indeed, looking at what Fed policy expectations are showing us here, we in fact see that what we're looking at is a 92% chance of a hike for the May 3rd meeting. In that percent hike cut column, you can see 92.4. In the next one, the implied rate delta column, you can see 23 basis points of a 25 basis point hike already priced in. And when the odds are that high, it's pretty well a given, unless something really out there occurs, that you're going to get that move. You can see that come June, there's only a 24% chance of a further hike. So at that point, you can see 29 basis points of the 25 are baked in. So a very slight chance, 17% chance that you're going to get any more of that continuing, that essentially you've peaked by then. And then come July, September, you can see stasis. So the implied rate delta based on current rates now. In July, 24 basis points, so we still have that one hike. By September, you can see rates are already dipping back under 5. The implied rate there, 4.93. So you can see that already about half of the tightening is starting to filter out. And then come November, rates are unchanged, which means that by then we have our cut. By then, we are looking at that one cut essentially already in. And you can see the implied rate there, sub 475 at 474. So just on the cusp there. By December, that cut is all the way baked in, the rate at 4.54. By January, it looks like we've cut a full 50 basis points as relative to now, and the rate is already at 4.3. So meaningful cuts there. So by October, you've reversed the hike, well, or November rather, as I mentioned earlier, no meeting in October. By November, you've reversed the hike. By December, you've cut by an extra 1 time. By January, you've cut by an extra 2 times. That's the landscape. So ostensibly, these home builders are going to be encouraged by where this is starting to trend to make the preparations they need to make and to begin to bring more supply to market, anticipating that the peak in rates might encourage buyers. Those buyers might come in and they'll need inventory to be buying, and these home builders will want to be selling. If in fact we're going to get a rebound in sales and we're going to have an opportunity for them to take advantage. So that's, for now at least, a view being endorsed in markets. And herein is where this gets interesting from a sequencing perspective. Notice that this most recent uptick in the first quarter in building permits and housing starts comes to us even as the price continues to fall. And given how long it's taken to get from even the start of supply being taken offline, never mind, as we saw earlier, where the sales peak was. As we saw earlier, the peak in sales, we can just go back here, was back in Q3 of 2020. And the peak in prices almost 2 years later. The peak in expansion for building permits and housing starts is Q4 of 21. So we're talking about a year and a half before we are really looking at those kinds of things really starting to show up in the price. So going the other way, the lag from peak to peak here, you can see is a little bit tighter, but again, remember, these are quarterly numbers. So what we're looking at is a peak in supply growth, at least most recently in Q4 of 21, and the starting of the rollover in price not happening until Q2 of 22. So there's essentially a 2-quarter lag there. And so what you're then looking at, which might seem a little bit counterintuitive until you consider how long things take to clear markets in the housing space, that the price is going down even as less supply is being provided. So ostensibly, the market is getting tighter, but the price is declining. Now, with rates perhaps having peaked, supply starting to recover, but prices still have a long lagged tail to go. Ostensibly, that tail might actually be made longer if this supply comes on and the market actually starts being better supplied with housing before really the ship is going to turn on prices. and could actually drive them lower still at the back half of this cycle, or the back end of this cycle. And so the way forward for house prices appears to be lower for quite some time yet. And if it's a recovery in sales, a lasting one that needs to happen, those lags could be even lower, although in the first quarter, sales did bump back up a little bit. So as we look at this data here coming in, what are the upshots for broader markets? Well, on the one hand, lower housing prices for longer probably helps with the Fed's inflation fight and probably reinforces the idea that rates are not going to keep rising, at least not for very much longer. And that's fair enough. That's something that reinforces the idea that the Fed won't have to turn around and hike more aggressively still. That's probably something the markets can like and appreciate. But what it also means is that this is actively undermining consumers' household wealth because the price of homes is coming down. And to the extent that these prices still have a long tail to go, you might actually start to, number one, inspire more sales, driving the price still lower, but also to inspire broader risk aversion in markets because, of course, so much is collateralized by homes. So much is hinging on homes as a key part of the U.S. economy. There's a huge wealth effect that has been observed over the years where when the price of homes comes down, consumers retrench on spending because they feel poorer. And so what this might do is apply the kind of pressure on the U.S. economy that actually makes the incoming downturn less likely to be a soft landing, more likely to be a deeper recession. All of which, of course, prolongs the decline in house prices because at the same time that this decline is ongoing, that wealth effect discourages those new buyers that are being wagered on here. And so the overall upshot becomes, well, Fed policy expectations are already pretty well anchored, pretty well established that we are not going to get much more rate hikes after next week. So there's maybe not a whole lot of supporting story there in driving CPI lower via housing prices over the coming quarters. The reaction function there is perhaps already spent. But the negative growth implications of falling house prices, which given the lags probably have quite a bit longer to run, those remain. And so the overall story here, perhaps much more risk off for broader markets than the alternative, which of course bodes ill for stocks, bodes ill for growth-geared currencies and commodities. Let's call it crude oil, copper, Australian dollar, Canadian dollar. Certainly bodes ill for yields for all of the above reasons, and may be supportive for defensive alternatives. So bonds, perhaps the yen, perhaps the US dollar. And of course, looks decidedly negative for house prices for quite some time yet. And that is macro money for today. Thank you very much, everybody, for joining me. I am here all week, Monday through Thursday, right after overtime with friend of the show, Chris Vecchio, head of Futures and Forex here at Tasty Live. I'm back on with Chris on Friday, but this time for Futures Power Hour. I'm then on with Tom and Tony on Sundays for First Call. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much once again, everyone. Godspeed. Happy trading out there. See you tomorrow.